Hello guys, welcome to another video. So today in this session, we are going to talk about something every investor need to be aware of. The 5 common investment mistake Indian investors normally make and how we are going to avoid them. See, mistakes in investing are very common, but learning from them is what truly make you a successful investor. So in this video, we will discuss these common mistakes and their consequences and how can you avoid falling into these traps. So if you're serious about building wealth, stick around till the end. So I'll be discussing everything related to the investment mistakes and the solution to that. The mistake number one is chasing high returns. So let's start with the mistake that almost every investor have made at some point of time, that is chasing high returns. Many new investors look for schemes for investment that promise extraordinarily high returns, and this often lead them to risky ventures like they'll buy penny stocks or they'll go for speculative IPOs by expecting that first immediate gain in the first 1 week itself, or even scams. So if you see, a classic example of this was the Ponzi schemes that actually promised a return of, let's say, 30% per month. 30% per month means 360% per year. How is it even possible? And several investors, in fact huge amount, has been put in their these schemes, that to their hard-earned money, only to lose it all of that money when they have taken it away and then when they have run away. So see, at one point of time these schemes will collapse and then you will lose money. See, remember always, if something sounds too good to be true, then it's probably a potential scam. So what could be the solution? Focus on understanding the risk return trade-off. High return often come with high risk. So you must assess whether you're comfortable taking on that risk. So instead of chasing high returns, aim for consistent and moderate returns over the long term. So for instance, you see equity mutual funds have historically provided average return of 12 to 15% annually. If you look at the last 1 decade. So 12 to 15% annually is a very decent return where you can double your capital, in 5 to 6 years. So that's very decent return, okay, without taking any risk, much risk. Second mistake that we need to discuss. So that's another common mistake, that is a lack of diversification. Many Indian investors tend to put all their money in one asset class like stocks or fixed deposit or even gold. So it might seem easier to manage, but it increases your risk significantly. For instance, during the COVID-19 pandemic, you can see the stock market saw a massive crash. Investors who were fully invested in equities saw their portfolio drop drastically. But on the other hand, those who diversified into assets like gold or debt saw lower declines in their overall portfolio. In fact, gold was going up at that point of time. So what you need to do to solve this mistake, diversify your investment across different asset classes, equities, debt, gold, and even real estate if you can. So within each asset class, further diversify by investing in different sectors or different funds. So this approach helps balance, risk and reward. So that's again very important that you need to consider. So again, many investors in India fail to properly assess their risk tolerance. That's actually the another mistake, ignoring that risk assessment part. So your risk tolerance is your ability to handle fluctuations in your investment. Now, if you're ignoring this, it can lead to panic during the market downturns, and that will cause you to sell off your investment at the worst possible time. So you need to have that calculation properly. For instance, if you're close to retirement and have a significant portion of your portfolio in small cap stocks, you're exposing yourself to a very higher risk. And small cap stocks are highly volatile, and during the market correction, they can fall drastically. So, what is the solution? See, take time to assess your risk tolerance based on your age. So, 100 minus your age, we discussed this before. So, if your age is, let's say, 40, then 100 minus 40, 60 percentage can be in equity. But as long as the age is increasing, you reduce that. Let's say 50, then 50-50. Your age is 60, then you are at retirement. So 40 should be in your equity, and the 60 you diversify in debt and other more safe instruments. So that again have to make your financial goals and ensure your income stability also. For instance, if I give you an example, If you are in your 20s with a steady job, you can afford higher allocation to equities. So let's say you are 25. So 100 minus 25. So you can go for 75% in equity. But if you are in 50s nearing retirement, then consider shifting your position to safer investment like debt funds or bonds. So what you need to do is, when you can shift, okay, manage that particular percentage that we discussed and keep shifting it. Okay, now there is a bigger mistake, that following the stock tips blindly, this Telegram tips and WhatsApp tips. That's a common mistake that many actually follow, either from friends or families or social media, or from the tips provider. And this is especially making bigger losses and lead to a lot of uncertainties. So word of mouth recommendation, it could be from friends also, family also, social media also, but mostly you'll get into trap of some telegram channels. It might seem harmless if it's like from family member, etc., but investing based on stock tips can lead to significant losses, and eventually that is actually what happening. The popular example of this is like yes bank crisis. So in its heyday, if you see, Yes Bank was the favorite among retail investors due to its attractive stock price and frequent recommendations from stock market forums at that point of time. But when the bank faced financial troubles, its stock plummeted, wiping out entire capital of the investors at that point of time. Wealth is gone completely. So now, then what is the solution? Always do your own research before investing in any stock or any asset. Look into the company's financial health, the management part, and the future growth prospect. Make sure that the fundamentals of the company is very strong. So use fundamental analysis to assess, whether the stock is worth your money. So if you are unsure in that case, then consult a financial advisor who have the knowledge in this, not your friends, not your relatives, and not word to word communication, publicity or anything. So again, the fifth one that we will discuss is not having a financial plan. Many investors start investing without a clear roadmap, and that lead to impulsive decision and misalignment with their financial goals. Without a plan, you are more likely to make emotional decisions like selling during a market dip or over investing in a single asset class. For example, during 2020 market crash, many investors panicked and sold their stocks at very low price, only to see the market is recovering within few months. Had they, if they had a clear financial plan in place, they might have stayed invested and benefited from the market rebound. Or in fact, they might have added more during that dip. So, what is the solution for this kind of situation? Create a financial plan that outlines your goal and your investment strategy and also your risk tolerance. So that's very important. And your plan should include short-term, medium-term, and long-term goals with a clear investment strategy for each of these. So for short term, for medium term, for long term, you need to have a very clear investment strategy, and you need to have that clear instruments where you're going to invest. For instance, if your short term goal is to buy a car in 2 years, then consider investing in a debt fund rather than equities, as debt funds are more stable. Okay, so one more mistake. This is a, you can consider it as a bonus tip that actually came to my mind at this point of time. That's the overconfidence. In fact, overconfidence bias. Okay, see, many investors believe that they can predict the market movements based on their knowledge or past successes. But the reality is that the market is unpredictable, and even the seasoned investors can't always get it right. For instance, if you see in 2016, after demonetization, many believed that the market would crash. But what happened? The market rebounded strongly and catching many off guard at that point of time. So what you need to do, stay humble in your investing journey. Understand that no one can predict the market movements with certainty. Market is uncertain, but the market success you will get if you keep invested over a long period of time. Keep invested consistently with discipline. That's what actually help you. So having these clear financial goals and risk management and financial planning, it's very essential. So stick to your financial plan and avoid trying to time the market. It is impossible, nearly impossible. Okay, so let's quickly recap of the 5 common mistakes that we have discussed. So what all things we discussed? First one, chasing high returns. So what you need to do, focus on consistent returns rather than trying to hit the jackpot. It is very difficult. Then second mistake that we discussed is lack of diversification. So what you need to do, spread your investments across different asset classes to minimize the risk. Third, we discussed this about ignoring the risk assessment. So understand your risk tolerance and invest accordingly. Have plans, short-term goals, medium-term goals, and the long-term goal. And following the stock tips blindly, always try to avoid that. Do your research before you invest in any stocks. Do the fundamental analysis. So again, not having a financial plan is another big mistake. So create a plan that will guide your investments and will help you to stay disciplined. So, guys, being aware of these mistakes and actively avoiding them is what actually required. You can significantly improve your chances of achieving your financial goals if you follow this. So, before we wrap up, let me leave you with some final thoughts also. See, one very important thing is if you are not yet started investing, start. So start small and be consistent. Don't wait for the perfect time to start investing. Begin with a small amount and increase your investment gradually. The best time to start was yesterday. If you missed it, second best time is today. You cannot miss this day. So start small, even if it is small, start today and keep investing with discipline, and always keep emotions in check. Emotional decisions can often lead to mistakes. So stay calm and focus on your long term goals. Always review your investments periodically. So set a schedule to review your portfolio at least once in a year or at least once in 6 months. Rebalance if it is required. So, guys, that's about this video. So, I hope you got some valid points. Thank you so much for attending. In case if you need any help or any mentoring or anything, you can get in touch with us. Thank you so much.